Hello and welcome to this Risk Minds webinar, the very first of our new webinar series. I'm Ed Stapley, Editor-in-Chief for the Risk Minds conferences. We'll also be live tweeting this webinar, so you can join the conversation using the hashtag #RMWebinar. So, differences in risk management techniques exist between insurance markets and investment markets. Do they result exclusively from a difference in environment, type, or class of product, or is it simply an accident of ingrained cultural approach? If neither, are there useful cross-pollinations that can take place between the markets? Is the difference simply a function of language? Do you need to be bilingual in insurance and investment? The convergence of insurance and investment market and the catastrophe space has brought some of these questions into high relief. Today I'm joined on the line with Morten Lane, who is the Director, Master of Science in Financial Engineering at the University of Illinois at Urbana-Champaign. He'll be discussing transferable lessons between insurance and investment risk management. So welcome to Morten, but before I do hand over, I'd like to remind everyone who signed in that we'll be holding an interactive Q&A after Morten's presentation. So if you have any questions during the presentation, you can send them to us using the orange Ask a Question button at the bottom of the screen, and you can submit these at any time. So what I'll do now is I will hand over to Morten, who is going to take things from here. Thanks, Morten.
Thank you, Ed, and good morning, everyone. I'm delighted to be able to do this webinar. And I should explain by way of background that I have spent time in the derivatives markets for more than a decade and a half, but also in the insurance markets, and I find myself now back in the high-frequency trading market. So I've had what might be called an unusual experience, and it is that provokes me to ask this question about whether or not there could be lessons learned from either side on the way risk management techniques are conducted. What I'd like to cover today is, first of all, an introduction to the insurance markets, because a lot of people from the investment markets are not so familiar with the practices there. I take a simple example, and I'll take some general view of the ILS market, and perhaps if we have the time, how risk is analyzed there, and maybe what that implies for how it could be analyzed in the investment markets. The graphic on slide 5 is intended to show the chain of the way risk is transferred in the traditional insurance markets. This is the chain that has lasted for the last 350 years. We're going to talk about it specifically in the case of catastrophe insurance. On the left, you will see a box which says insured. That's you or your parents or your grandparents who are buying homeowners' property insurance. They buy that from an insurance company, the insurer, and they get a policy in exchange for that, and they rely on the capital of the insurer. Those insurers actually sometimes accumulate more risk than they want to from all the policies they sell, and they will conduct a negotiation with a reinsurer to take part of that risk. That's often called a treaty, and most of those treaties these days are of an excess of loss character, and I'll come back to that. There is, in fact, a final link in that chain, which is the tail at the end of the dog, if you wish, which is reinsurers themselves find that they have concentrations of risk, and they transfer some of their risk to retrocessionaires. So that's the traditional chain, and the significance is that on the left-hand side of that curve, where we're talking about insureds and insurers, the distribution of outcomes can often be represented by a normal distribution with the central limit theory covering premiums and so forth. On the right-hand side, however, as that awkward risk gets passed up the chain, increasingly the normal distribution of losses is not an appropriate model, and long-tailed distributions, the tail being on deep losses is more appropriate. And it's right there that I think that there are things to be learned from one market to another. Just to demonstrate how this works, if you look at slide 5, you can be reminded of Katrina, the hurricane that devastated New Orleans in 2005. In 2005 dollars, the insured losses were approximately $80 billion to all the people who bought homeowners policies. They recovered that from their insurance companies, but the insurance companies had passed some of that loss up to the reinsurers. So in fact, only about half of it came from the insurers. Almost another half came from the reinsurers, and then there was a small amount that went to the retrocessionaires. That's the way it has worked, and if you take a loss, if you take a risk, you may take a loss, and that's the way the loss will go. Moving on, in the last 15 or 20 years, a new entrant has come into that chain, and that is the investment bankers have decided that they have a view about transferring risk. And so they have taken these risks that traditionally were passed horizontally along that chain by insurance brokers and have decided that some of those risks can be packaged in the form of bonds and sold to the capital markets. The vertical arrows, therefore, are representing registered broker-dealers transferring some of this insurance risk into the capital markets. Typically, those transfers, those bonds, have been called cat bonds because most of the risk that has been so moved in this way is from the catastrophe market. But to put a grander title on it, and the title that the industry prefers these days, they are insurance-linked securities, or ILS. And that title is intended to convey that it may cover more than the catastrophes. If you look to the bottom of that slide, you'll see that it's not just insurers and reinsurers who are issuing ILS. The insureds themselves can issue and actually take no part in the insurance chain. Tokyo Disneyland is threatened by earthquake in Japan, and they have issued bonds, ILS, to protect them against that earthquake risk. Some familiar names of insurers, USAA, Chubb, Liberty, etc., have been insurance companies that have issued bonds, and reinsurers like Swiss Re, Munich, and a lot of the Bermuda companies have also issued bonds. Just to spend a moment on the retrocessionaires, you will see it tends to be a little bit incestuous there because that third step, or fourth step, actually takes place among reinsurers themselves. So there's a concentration of risk up there. Remember that as we go along that chain, the risk that's being transferred becomes more and more asymmetric. Also note that, as I mentioned earlier, insurance brokers typically have done the horizontal part of the chain. Investment bankers have done the vertical part of this chain. They initiated this change in the markets. And so insurance brokers have become registered broker-dealers themselves, and they have joined the investment bankers so that Aon Capital Markets, Marsh McLennan Capital Markets, Guy Carpenter are now issuers of bonds in addition to Goldman Sachs and Paribas and the other names that appear in the market. It's not a huge market. On slide 8, you can see the annual issuance is 2016 year-to-date is $7 billion. And so we have had several years where the issuance has been around $8 billion. We expect that to grow. But I should make this point. There are other forms of capital market instruments that have developed alongside the ILS market. One, which is easy to conceive, is a sidecar, which means that you ride along with an insurance company. Another is collateralized reinsurance, where you will actually take the risk from an insurer and provide collateral against that risk, and do that individually rather than syndicated, which is what the ILS securities are. And in fact, there is perhaps double the risk that is taken in the ILS market compared to the size of the ILS market that is taken in this alternative risk market, which is this capital markets entry of risk. One other point which I think is worth noting on that graphic is that there is a shaded area at the bottom of each column there, and the shaded area represents life securitizations. Insurance companies have used the ILS market to protect against extreme mortality events, and recently they have begun to protect themselves against health events. So ILS is the term that says that there are broader risks to be covered. This is something of a demonstration that those risks are being covered. I think that as the market becomes more mature, we will see ILS securities issued to cover pandemic. It's certainly been proposed by institutions such as the World Bank. I think coastal erosion is one thing that global warming is prompting. And I also think there is the chance of using the ILS market and the insurance-linked securities vehicle for protecting against concentrated, non-diversified risks that investment managers find in their portfolio. Just to put some flesh on these bones, I've included in this presentation an example of a particular bond which was issued by the state of Mexico in 2012 and has had an interesting experience and shows both the good and the bad things that can happen if you issue bonds. Just to highlight some features of this dense graphic here, which is slide 9, the top left-hand corner shows the typical thing you'd find on a prospectus. And what is interesting to note is that the three sponsors, managers of the deal, are Swiss Re, Capital Markets, Munich Re, and Goldman Sachs. There's the mix of the insurance brokers, the insurance takers, and the capital markets divisions together with the investment banking division of Goldman, as represented by Goldman Sachs. Now, this particular bond is what's known as it's known by two things. One, it's a sort of cat in the box. If the catastrophe happens in a defined box, then the bondholder pays. And it's also known as a parametric structure. If I take the bottom left-hand graphic, you'll see several boxes there which represent, for the state of Mexico, zones of higher earthquake risk. One in the Gulf of California, the other around Mexico City. Now, what's distinctive about all ILS and compared to any other bond is that you will, when you receive the prospectus, get a risk analysis by one of three designated risk modelers, and those risk modelers will provide you with a whole risk profile that you will take by buying this bond. In the case of the earthquake tranche, lower left, those modelers say that the expected loss, in other words, the probability of you having a loss times the amount of the loss, is 4.4% annually. This is a 3-year security. The coupon that you received for taking that risk was 8%, and 140 million of these securities were issued. What's interesting is that the payoff, if it hit any of those boxes, was binary, in the sense of if there is no event in those boxes, you get your principal back and you've also had your coupon. If there is an event, then it's a total loss to the part of the bond that you wrote. In the upper right-hand graph, you'll see that the state of Mexico also wanted coverage for an Atlantic hurricane. They put 2 boxes there, one in the Yucatan, where some of the holiday real estate exists and is exposed to hurricane loss, and some up near Veracruz, where some of their port facilities exist. In that case, the issue size was 75 billion. It was binary. The expected loss was 2.73, and the coupon that you received if you bought that tranche was 7.75. And then just concluding the set, the lower right-hand graph, the expected loss, first of all, the coverage was for a Pacific hurricane, which covered much of the holiday coast of Mexico and the Gulf of California. And the expected loss that you got there was 4.35%. The coupon you received was 7.5%, and the payoff function was a step function, so that you could lose 0 if no event happened. You could lose 50%, or you could lose 100%, depending on what events happened and when. Now, contained in that are a couple of things which are important to note. One is that when it comes to risk management and investment portfolios, by and large, all the payoffs are linear rather than step functions or binary functions. But the insurance world is full of step functions and binary functions in terms of payoff diagrams. Actually, most of the ILS have linear payoffs as well in their model structure, which I'll come to in a moment. But it's notable that anybody who is trying to design an underwriting portfolio of ILS securities is confronted with this business of mixing payoffs, which I don't think most investment managers are confronted with. Just to show you what has happened with this security, it was issued in 2014. It was for 3 years, and in 2014, the box in question was traversed by Hurricane Odile. And you can see that tranche that referred to that exposure actually dropped in price from around par to around 50%. So the market thought that they may have lost the first step on that step function. In fact, there were 2 triggers associated with that. Not only did the hurricane have to go through the box, it also had to exceed the pressure while it was in that box that was specified in the deal. And it turned out that when a final measurement was taken, those 2 conditions were not satisfied, and there was no loss from Hurricane Odile. The price of that bond went back to par. Now, what is shown there are some of the difficulties with parametric bonds. Obviously, this was a hurricane that caused loss in Mexico. It just didn't cause the triggers to be executed. However, a year later, Hurricane Patricia went through the same area, and you can see that the quotes on that tranche of multi-cat Mexico actually dropped, and in fact, this one did result in a payoff of 50% of the bond to the state of Mexico. So, why do people do parametric bonds? Well, because they're easy in a country that doesn't have a huge insurance substructure. One other reason is that they are asymmetric in terms of information. The insurer, the buyer of the bond, doesn't have any more information than the state of Mexico, and vice versa. And so they are impartial in that sense. But just before we leave that, I should mention that there are four classes of types of ILS securities. One is this parametric type. Another more common one is indemnity, where you will actually pick up the losses of whoever you are insuring. That one is used mostly in the U.S. market. Outside of the U.S. market, and possibly with the exception of Europe, there is a good substructure that people can base on. Sometimes you can use an index, and sometimes you can use a model to determine who gets paid what if there is an event. I'm going to pause here for questions. I can go on way too long. Let me just all right, well, let's just go straight to questions.
Yeah, thanks very much. I think a lot of the stuff you were talking about there incredibly timely with what's going on in the US at the moment. I think I'd love to sit and listen to you for sort of another 30 minutes. It's fascinating stuff. But I am worried that we have about 8 minutes now for questions. And sure. If you don't mind, it'd be great to get some of those in.
Let's do that.
And a reminder to everyone who hasn't submitted a question yet, you're able to do that at the Ask a Question box at the bottom of the screen, which is in orange. And so at any point, do submit a question, and we will try to put that to Morton. Just to kick things off, I wanted to ask, is assuming risk or ceding risk of insurance risk the equivalent of buying or selling an investment?
Well, that question provokes the comment that insurance and investment managers use different language, and somehow you have to become bilingual to understand what's going on. When I talked about that horizontal chain early on, the horizontal part of it, the insurance companies will buy in protection rather than buy in risk when they got a treaty with a reinsurer. They were buying in the sense that they were paying premium. When you go to the vertical part of this and you're buying an ILS, you are actually assuming the risk. You're buying the risk and putting up your capital for which you get a premium. So they're similar concepts, but you just have to be careful of the language that you use when you're talking about the risks being transferred in either market.
Right, okay. Another question I've got here is, in the catastrophe market, what was the correlation coefficient between hurricanes and earthquakes?
There is no correlation between hurricanes and earthquakes. However, if there is an insurance company that writes policies in California and writes policies in Florida, then, and you try to reinsure that company, then you are going to pick up both of those risks. And if there is another company that just writes policies in Florida and you reinsure them, then you're going to end up with some correlation between the risks that insurance company A and insurance company B both write in Florida. And that distinction there, that means that it's not easy to use mean variance optimization the way investment managers do when they go about portfolio construction for their investments.
Mm-hmm. Mm-hmm. That's great. And how about the correlation between the risk between insurance companies who write both covers?
Well, I think I just commented on that. Then a correlation is generated. And so what the reinsurers and the retrocessionaires would like is to just reinsure Florida risks and California risks, maybe European wind risks, Japanese earthquake risks, and pick and choose and assemble a portfolio. They do not have that luxury. What they have is the ability to reinsure insurance companies who may or may not have correlated losses. And they have to figure that stuff out, and that's what's important and distinctive of the way they have to construct their portfolios. Let me make one other comment on that, and it is that an awful lot of the risk that is transferred is event risk. In other words, if there is a hurricane, if there is an earthquake, we want you, Mr. Reinsurer or Mr. ILS bondholder, to pick up the losses that result from that event rather than losses that just arise in the ordinary course of business. So event risk and correlation are very important to constructing an underwriting portfolio.
Okay, that makes sense. And is one more important than the other? Is event risk more important than correlation, or?
It's not that one is more important. I think it's that you have to take both things into account. And the way reinsurers have done this is that they utilize the services of these modeling companies that I have talked about. And the modeling companies will construct scenarios that represent what things can happen in the world of catastrophes. So, for instance, the typical modeling company will give you 10,000 scenarios, and it says in scenario 1, there's no hurricanes, there's no earthquake, there's no loss. That could go on for 50% of the scenarios. 5,000 scenarios are like that. Most of the time, there is not a catastrophe. But in scenario 832 is a year when there were a lot of tornadoes, there were a lot of hurricanes, and maybe an earthquake, and that causes losses. And so they will take those scenarios and run them through their portfolio. Managers of cat bond portfolios will take those scenarios and run those things through their portfolio and look at those scenarios which cause maximum loss to their portfolio and try to arrange the portfolio in such a way that they don't incur those maximum losses. That's kind of different from the way investment managers look at their history, and they say, well, I see that these stocks move together in this correlated way, so I don't need both of those at 100%. I need to diversify a little bit. And so that diversification, which is so central to investment risk management, takes a lesser place in insurance risk management, where they're very much concerned with the long end of the tail in their portfolio.
I've got another question here that's just come in here, Martin. Says, how do you see the capital arbitrage between insurance and investment banks for risk passed between insurance and investment bank? What price is attached to the difference in capital to be set aside between industries?
Can you repeat the first part of that?
So the first part of that is, how do you see the capital arbitrage between insurance and investment banks for risk passed between insurance and investment banks?
I'm not sure there is a capital arbitrage. Here's the way I look at it, and you can see on my last slide there, my website, and you can go look at some of these things. The ILS market is a small window into this traditional market. before the ILS market existed, it's impossible to buy the Wall Street Journal or the Financial Times and find out what the cost of insurance is. You still can't do that, but at least you can get a price sheet on the ILS market, and that gives you some indication of what the premiums are going to be charged in the traditional market, because they go together. Not lockstep, but they move together over time. One of the things I've done in some of the work I've done is to take this ILS market that we can see and say, what if I were to insure that in the guise of a traditional reinsurer? What sort of returns would I get? That is a leveraged version of what a hedge fund that does ILS with no leverage can do. So it's not so much that there's an arbitrage there, but there is a difference of leverage, and I think that's a useful line to explore in terms of thinking about the traditional market and this new market.
Yeah, that makes sense. Well, I'm afraid that is actually all we have time for. That sort of flew by. But of course, you're going to be at Risk Minds in December. I know that a few people here are going to be joining us for that, and also people who are able to follow up with you as well. So I want to extend my thanks to you, Morten, for joining us. As I said, very excited to see you in a couple of months, this 5th to 9th of December in Amsterdam. And, we'll be seeing amongst yourself some of the world's best risk managers, CROs, academics, and many others coming to discuss risk management and what it means right now, but also looking ahead to 2017. If you do have any feedback to those listeners on today's webinar or any recommendations for future webinars, please do complete our short survey at the end of this webinar. That will flash up shortly after we finish up here. So thanks again to Morten, and hope to see you all again soon.
Thank you, Ed. I'll see you in Amsterdam.